Dude, I got the worst sleep last night. I'm running on empty. But did you know that some of the best dividend paying stocks are in the banks category? And some of these bank stocks, they have a dividend yield that's just as high as REITs. Except the dividend payouts are going to be qualified, meaning it's going to be taxed at a favorable rate. And a fun fact is, up until the 2008 Great Recession, banks were some of the more popular stocks to invest into. However, since 2009, they're still trading at a PE ratio that's almost comical. So in this video, we're going to examine, grade, and rank the best bank stocks out here. And this is an ongoing series that is pretty thorough, where we examine the best of the best in particular industries or sectors. I already made a video on REITs, BDCs, dividend income focus ETFs, dividend growth focus ETFs, and the list goes on and on. This one is going to be banks. So without further ado, let's go ahead and get into it. And for clarification purposes, there's many different types and flavors of banks. You have investment banking, you've got commercial banking, you've got wealth management, you've got retail and consumer banking, and the list goes on and on. But in this video, we're going to be considering the commercial and community-oriented banks rather than the investment banking ones like Evercore, Jefferies, Lazard, Morgan Stanley, etc. However, with a big caveat, because there are also banks that are considered universal. Reason being is that they are a one-stop shop and they do it all. They can paint the fence, do your car's oil change, and even mow the lawn. Meaning they do investment banking where the big money is made with mergers and acquisitions and divestitures, but they also service the little guys just trying to deposit their $500 paycheck. And if you're curious as to which banks I'm referring to, we're talking about Bank of America, Wells Fargo, JP Morgan Chase. So how exactly are we going to evaluate the bank stocks? It's very difficult and a challenge to compare apples to oranges because when you think about it, most of these banks that we're about to talk about, they specialize in one type of loan over another. So who is to say that auto loans are better than student loans? And the list goes on and on, right? We can keep comparing this against that. So to keep it objective as possible, because whenever it comes to evaluating or ranking anything in life, it's pretty darn subjective, right? So we're going to judge them based off of these metrics. What you see on your screen right now, their dividend profile, their CAGR, the tangible book value per share, and the return on equity and return on assets. Now, if you already know each one of these metrics or you just don't care, then feel free to skip ahead in the video. You can refer to the table of contents. It should be in the video description or in the pinned comment. Does anyone even look at that anymore? Table of contents is there. But first and foremost, why exactly are we looking at the dividend profile? Because if their financial health, the loan books, and profitability are in order, the dividend is going to be the consequence, the result, and the output of how well their operations are going. Because in order to grow and pay the dividend, the bank needs to be crushing it. You can't just fake it and finance your dividend through loans or smoke and mirrors. I mean, you might be able to for like a year or two, but it won't be sustainable. So the dividend is a really good way and a proxy for the free cash flow. And then when it comes to the CAGR, the compound annual growth rate, it's how much your money would have grown into this bank stock year over year when you take into account the share price appreciation plus the dividends paid out. Because when you look at Yahoo Finance, Robinhood, or even Google Finance, you only see the share price appreciation, which isn't exactly the full picture because the dividends are not accounted for. And the reason why we refer to the CAGR instead of the total return is because when we break it down year over year, then it's really helpful for us to compare stock A to stock B, especially when their timeline doesn't exactly line up. And ultimately, I don't know about you, but the performance matters. So the CAGR is if you do all of the little things right as a bank or as a business, and you beat your expectations that you laid out for Wall Street and other investors, and you keep growing the business and you do all of the correct actions, moves, and operations, then usually, not always, but usually the market rewards you by your stock price increasing slowly or aggressively, depending on who you are. And as sad as it is to say, you wouldn't want to invest into a quote-unquote good bank stock if they have a poor performance in the stock market. So not only do they have to be a good business underneath the engine, but their performance on the racetrack needs to be good as well. So good and good together equals excellent. By the way, you see my name tape right here? I always pronounce my name Amos, right? Like famous Amos. But come to find out, the proper way to pronounce it in Judaism and in Hebrew is Amos. And in Europe and other places in Asia and Africa, they pronounce my name as Amos instead of Amos. So I don't even know anymore. And between you and me, I really like the sound of Amos. And I really wish I would have known that when I was like 5, 6, or 7 years old because, dude, the bullying that I received on the playground or in recess or by other school kids growing up, referring to me as, the butthole, dude, it was relentless. It was pretty bad. Had I known that my name was actually pronounced Amos or Amos, dude, it would have saved me a lot of that. But I think it was character building and it gave me really thick skin. So maybe all the bullying wasn't so bad after all. But anyways, I digress. The next metric that we're also going to consider is the tangible book value per share, because it's a way for us to gauge how their tier 1 capital is doing year over year. Much like how we use the AFFO when it comes to REITs, we can refer to the book value for banks. And why does this matter? Because it shows us whether or not the true equity value of the bank is growing. What we want to see in a perfect world is their tangible book value growing year over year. And if that's the case, it is evidence that the bank has disciplined operations and their balance sheet is also going to be spectacular. And then we're also going to consider the tangible book value per share ratio by taking their market share price and dividing it by the tangible book value. And the ratio is going to tell us if the bank is overvalued, undervalued, or even high expectations being baked into them, trading at a premium multiple like Microsoft. It's kind of similar to what we do with BDCs and the NAV per share. It just helps us to see where their evaluation is at. And a good number is usually around like a 1.3 to around a 1.6 for a bank. And then last but not least, we're going to measure and assess their profitability and quality of those profits through the return on equity and return on assets. We use both of them because let's say if the ROE, the return on equity is very high, but the return on assets is low and the bank has a ton of leverage, they're probably masking risk. So a good return on equity also needs to be balanced with a good return on asset. So in this case, in the context of banks, we want to see the return on equity be above or around 12%. 10%, we'll say it's okay. 12% is the golden standard. And if it's higher than 14 or 15%, then this bank is crushing it. And to balance it across the board, we want to see a return on asset somewhere around 1%. 1.1%, even better. 1.4%, dude, that is crazy. If it's less than, say, like 0.8%, I think that's the minimum standard. 0.7 and the yellow flag's going up. And if it's anything less than 0.5 for the return on asset, that's a red flag. So, pop quiz, if the return on equity is like 15%, but the return on asset is like 0.3%, then we know there's a red flag and something's up. And consequently, we'll go ahead and deduct a point or two from that bank in their grade evaluation. Speaking of which, let's jump on over to the banks. So in this bank's grading and ranking video, we're going to be looking at 16 different banks. As you can see on the left side of your screen, some of them you might not be able to see because it's a little cropped. But how we're going to do it is everyone is going to start out with the grade letter of C. And then they're going to move up or down depending on their numbers and data. Meaning I'm going to leave my subjective and opinionated comments out of the way and let the data do the speaking. So the first bank is going to be Citigroup, ticker symbol C, what you see right here. And they do a little bit of everything, right? They do investment banking, retail banking, and even credit cards. And they operate in over 160 countries. And they're currently trading for about $68 a share. And I would argue their 5-year dividend growth rate of 2% is kind of low, but we'll give it to them. At least it's growing. And their 20-year CAGR being negative 7%, for me, that's a huge red flag, and I think that's really disgusting and almost offensive and racist. And something that I want to call out is when we take a look at their tangible book value per share, this company should, in theory, on paper, be worth $91.50. They're nowhere near that. Consequently, their tangible book value per share ratio is 0.75. And you might be like, dude, doesn't that mean this company is absolutely undervalued? Well, for me, I don't agree with that. I think Citi's ratio is really low because the business itself is struggling. And I think it's implied by their stock market performance being negative 7% year over year for the past 20 years. Dude, that is not good. That's no bueno, as we say in Mexico. However, when we take into account their tangible book value per share trend for the past 5 years, it is looking kind of good. It's up and to the right, and it's growing year over year. However, when we take a look at their profitability, this is also not good, right? The return on equity is 6%. That's below average, and the return on assets being 0.5%. Guys, I think Citi is at a very deep discount for a reason. Not only do they have poor growth year over year performance in the stock market, but their profitability is also really bad. So, is it any surprise that when it comes to Citi, we are going to put them into the category of A? No, I'm just pulling your leg. I think when it comes to Citi, we're starting this video out with a banger. I think that is what quantifies a bank stock into the F tier. And by the way, for my friends and family that are not from the US, an S is a grade that is given to a business or to a student's assignment or exam if it is like 100%, it is perfect, it is beautiful, delicious, and it even smells quite good. A grade letter of an A is just below that. It's still excellent across the board, but something, maybe like one metric or one factor, is holding it back. B is above average. C is if you're doing everything that you should be. You're not excelling, but also you're not failing. You're just decent. And for me, a C does not mean that you're trash. It means you're good, you're average. D implies that you're below average. E is a company that is kind of gross. And an F, as portrayed by Citi, you're just missing the mark in almost every metric, category, and criteria. You're just bad. Objectively bad. The next bank is going to be US Bancorp, ticker symbol USB. Oh, that's really cool. USB. Oh, I really like that. That is catchy because you can plug in something, but also it refers to what their name is. They're similar to Citi, except they only operate in the US. So it's a pretty universal bank. Now, when we take a look at their numbers, they're currently trading for about $39 a share. And their dividend yield, just shy of being 5%, I think that's pretty darn good. And when we take a look at the growth rate of their dividend at being 4.1%, I think that's pretty good. I like what I see so far. And their compound annual growth rate of 5% year over year, I think it's head over shoulders better than Citi. However, I don't think it's the greatest thing in the world because your money only growing by 5% year over year or in a 365-day period, it could be better. And when we take into account their tangible book value per share at being 1.6, I think it's a little pricey, but I think it's justified because so far, I think their metrics and their numbers, they don't look too bad. However, when we take a look at the trend of their tangible book value per share, it's inconsistent, and it showed a decline 5 years ago. However, since then, it's been slow and steady, growing, and reliably. And when we take a look at their profitability, I think this is pretty darn good. It's like textbook right there at the standard of what you should have for both the return on equity and return on assets. So when it comes to US Bancorp, I think this is a very solid bank company, but I would say they're above average. So as a result, I think they're going to be a C+, maybe even like a B-. However, for the time being, we'll just go ahead and leave them into the B tier. Eventually at the end, we might move them, but I think B is fair for now. And the next bank is going to be PNC, ticker symbol PNC. And they're currently trading for about $158 a share. They do retail banking, asset management, and corporate banking. And when we take a look at their numbers, I think their dividend yield is quite juicy at 4%, not as high as USB, but they make up for it through their dividend growth rate being 6.8%. When it's above the rate of inflation, which is historically around 3%, me likey. That's the standard. To see it almost double that, I'm a happy camper. I think this is really good. And when we take into account their performance in the stock market, the CAGR, 8.7% year over year, I think that's really strong. And their tangible book value per share, the ratio is a 1.1. It's almost 1 for 1, which tells me, dude, that's really good. That means this company is not overvalued right now. They're not trading for a premium, and they're almost fairly valued, almost in the undervalued territory. However, when we take a look at their trend for the tangible book value per share, it was a little inconsistent 5 years ago, but since then, just like USB, it's been slow and steady and growing and doing the right things. And when we take a look at their profitability, it's almost the exact same scenario as USB at 11.3% for the return on equity and a 1.09% for the return on assets. And as a refresher, we want to see at least maybe like a 10 to 12% to quantify it as good. And 11% for me, I think, is pretty darn decent. And for the return on assets, anything above 1% means it's really strong. So when it comes to PNC, I think this is a very strong and high quality bank that has good growth and profitability as evidenced by their numbers and financials. So as a result, I think it's too early and premature for us to put anything into the S tier, but I think they make a really good argument for what an A bank should look like. They're pretty solid across the board. I would even go as far as to say, as of right now, PNC is an A+, just missing the mark of S by a little bit. If their CAGR was a little higher, or their dividend growth rate was something crazy like 12%, and their CAGR was around like 10%, easily an S. But their actual numbers are a little smaller, so as a result, I think an A+ is fair for PNC. And the next bank is going to be Truist Financial, ticker symbol TFC. They were formed from the merger of BB&T and SunTrust Bank. They are a retail, commercial, and institutional banking firm. Now, when we take a look at their dividend yield on a surface value, 5.5%, you might be like, dude, sign me up. That's a really high dividend yield and I like what I see. I want to stop you right there, because you need to look at the other numbers and data to see whether or not this is a high quality company. Because the last thing that you want to do, this is not financial advice, is to invest into a weak or a subpar or an ugly business, because that's ultimately how you lose money. Now, with that said, their dividend has been growing at a rate of 3.4% year over year, which for me, I think that's the minimum standard of what quantifies as a good dividend growth rate. Anything around that 3% ballpark number. However, when we take a look at their performance in the stock market, growing at a rate of 3.7% year over year, that's pretty darn bad. For the past 20 years, dude, I just, no bueno. However, a redeeming factor for Truist is that their tangible book value per share ratio is pretty reasonable. A 1.2, that's not too bad. The perfect ratio would be a 1, and to be a 1.2, I would argue that's not bad at all. However, the trend for the tangible book value per share, it's all over the place. It's very inconsistent, which tells us the quality of their loans and their financial assets, there has to be a red flag. Something is going on. Or they're just issuing way too many shares year over year. Just something is not good. As a matter of fact, I'll look it up right now. Let's see if they are diluting the shareholders or not. And as you can see visually depicted by this graph, in 2009, there were 636 million shares outstanding. And since then, just look at how they've just been increasing the shares outstanding on the stock market. This is pitiful. This is ugly. And during the pandemic, they just increased the amount of shares that are outstanding by a boatload. Now there's over 1.3 billion shares outstanding. Now I can see why their tangible book value per share is an ugly picture. And when I say that, I'm not referring to the current ratio, ratio, but the trend for the past 6, 7, 8 years. And when we assess their profitability, very weak return on equity, a 0.1%. Dude, that is atrocious. To make matters worse, the return on assets is a 0.02%. It's almost flat and non-existent. So I think this is pretty bad in terms of the quality of their profits, but their ability to generate profit as well from the equity, but also their assets. It's not a pretty picture. So I think when it comes to Truist, are you going to call me ugly? Are you going to call me unreasonable if I put them into the A tier? No, I'm just kidding. They're nowhere near A. A is for A most, not A miss. I think when it comes to Truist, their tangible book value per share ratio, it screams that they're cheap, but I don't think they are. Because when you think about their profitability, it's shockingly bad. However, not all is ugly when it comes to Truist, because their dividend growth rate, the dividend yield is pretty good, and their CAGR is at least positive. It's not negative like Citi. So consequently, I think this is what quantifies a below average company. So somewhere between a D and an E. However, between you and me, I think they're closer to a D than they are to an E. So Truist Financial Bank is going to be a D. Tell me if you agree or disagree. And the next bank is going to be M&T Bank. Ticker symbol MTB, not mountain bike, but M&T Bank. And a fun fact about them is they are the only bank not to lower its dividend during the Great Recession. And another fun fact is that I actually interviewed for an equity research position with this company. And they're currently trading for about $167 a share. Their dividend yield is 3.1%, which I would argue is pretty good. It's not bad. I think 3% dividend yield for me is the minimum standard of what makes it a decent dividend yield. However, the growth rate is where I smile. A 5% dividend growth rate year over year, at least for the past 5 years, I think that's healthy and it's good. And when we take a look at their performance in the stock market, 5.6% year over year, it's okay. It's not the best thing in the world, but it's far from being ugly. Their tangible book value per share, the ratio being a 1.5, I think it's a little up there, but it's still pretty reasonable. And the trend, I think it's pretty consistently growing, except 2022. It went down by a little bit, but nothing too crazy. And when we look at their profitability, a 9.4% for the return on equity, I would say it's solid. It's not the best thing in the world, but it's pretty darn good. And the return on assets being a 1.2%, good. I think this is pretty solid overall. So all in all, when it comes to M&T, I think they have pretty solid numbers. I think it's just strange that their stock market performance doesn't match their metrics, because I think their numbers look pretty darn good. Now, with that said, I think M&T Bank is going to be above average. So I think we're going to put them right next to their buddy right here, US Bancorp, and they're going to be a B. And the next bank is going to be Huntington Bancshares, ticker symbol HBAN, and they're currently trading for about $14 a share. They do full service banking, including mortgage and wealth management. And when we take a look at their numbers, their dividend yield being a 4%, pretty good. Okay, don't unnecessarily correct me, please. It's a 4.2%. It's a little higher than I said, but still pretty good. However, the dividend growth rate being a 1%, I think that's pretty weak. That's bad. But hey, at least they're still growing their dividend payout. And when we take a look at their performance for the past 20 years, your money would have grown at a rate of 1.2% year over year. I think there's no way to manipulate it or spin it. That's pretty disgusting. That's really bad. Atrocious even. And according to their tangible book value per share ratio, they're currently trading for a premium. I don't know if it warrants that premium, but it is what it is. And their profitability, shockingly, is very, very decent. However, I don't think it's going to be enough to save them for the grade that we're about to give them. Because ultimately, I think Huntington Bancshares, mediocre bank that's struggling. So even though I really liked their profitability, their dividend growth rate and their CAGR just, not good enough. So in the context of the bank industry, I think for me, I think they're somewhere between a D and an E. However, as things stand right now, let's just go ahead and put them into the E category. I feel like I'm going to have to come back and revisit this one because they might belong over here, slightly below average, because their metrics for the profitability of what they're doing with their assets and equity is pretty good. It's almost surprising how their stock market performance is not matching and aligning with their metrics. It's kind of weird. It's one of those companies where I need to do a deeper dive into to figure out what exactly is going on. I know they're a smaller market cap, especially in comparison to some of these other names, but I think as of right now, they're closer to an E than they are to a D, because the deciding factor, the tiebreaker, when I think about their tangible book value per share trend, it was really volatile. It's not predictable at all. Sometimes it goes up, sometimes it goes down. There's no trend, which tells me they have bad loans, poor asset quality, risky strategies, or even weak management, meaning they're issuing too many shares. So there's a lot not to like about what's going on behind the scenes. So Huntington Bank shares is an E, unfortunately. And the next bank is going to be Key Core, ticker symbol KEY. They're currently trading for about $14.72 a share. This is a bank that does it all. However, they only operate in the US. And when we take a look at their numbers, I'm telling you right now, do not get infatuated by just the dividend yield. You might see a 5.5% and be like, I'm done. That's all I needed to hear. I'm going to invest into them. Before you do that, pump the brakes, pull up your pants, and take a look at the other numbers as well. That's not financial advice. 5.5% dividend yield, but is it growing at a good rate? I would say it's decent, 2.4% growth rate year over year. However, when we take a look at their performance in the stock market, it's not as ugly as Citi, but it is negative, meaning your money would have shrank by 0.7% year over year for the past 20 years with Key Bank. And when we look at their profitability metrics, it is absolutely horrific. It's an ugly return on equity of 0.14%. Dude, that's pretty darn bad. That's just as bad as Truist Financial Bank. And the return on assets is even worse than them at a 0.01%. So I think Key Core Bank looks cheap for a reason. At $14 a share and a 5% dividend yield, it is absolutely justified as to why their tangible book value per share ratio is as low as it is right now at a 1.1. So does it come as a surprise that we're going to have to put Key Bank into a category or a grade letter that's below C, somewhere over here? I mean, think about it, right? A weak historical return rate, negative 0.7% year over year, and no good numbers to defend itself, except the dividend yield. I think with their high dividend yield, it is what labels itself as a yield trap. You invest into Key Bank for their high dividend yield only for you to lose your money in the grand scheme of things and in the long run. So consequently, I think they belong right here next to Citi. This is an F tier and caliber bank stock. Now, I want to hear from you. Do you agree? Do you disagree? I mean, let me know, right? I think Key Bank, yes, their dividend yield is great, but the business operations and the health of the company itself is not good. And the next bank is going to be Citizens Financial Group, currently trading for about $37 a share. And they're one of the oldest financial institutions in the US, with roots dating back to 1828. Ticker symbol CFG. And when we take a look at their dividend yield of 4.5%, I think that's pretty darn good. The dividend growth rate at a 3.2%, so far, so good. But what about their stock market performance? Well, this is where it gets a little weird, because unlike the other banks that we have looked at so far, their IPO was September of 2014. They became publicly traded and debuted on the stock market a little over 10 years ago. Meaning their CAGR, their compound annual growth rate, we can only look at the past 10 years. It doesn't go back 20 years. And that's why I said we're using the CAGR instead of the total return, because it wouldn't be fair to only look at their past 11 years against the other banks' 20 years. Obviously, they're going to be smaller and lower, and then we would think they suck, when in actuality, they're not bad at all, because their CAGR is a 7.6%, which I think is pretty good. And when we think about their tangible book value per share trend, it was inconsistent about 5 years ago, but since then they have recovered, and it's slow and steady and growing. And their tangible book value per share ratio of a 1.1 tells us that their valuation is pretty fair. It's not cheap, it's not expensive, it's not bad at all. It's right where it should be. And when we take a look at their profitability, it's below average. It could be better. However, it's not disgusting like Key Bank or Truist. It's just below average. When it comes to Citizens Financial Group Bank, there's nothing that really stands out about them, right? They're very average across the board. I mean, their profitability is a little lower than we would like, but it's not ugly. However, the redeeming factor for them is their CAGR, or their performance in the stock market, has been pretty decent. right? A little over 7% or just shy of 8%. So consequently, I think this is what labels a C bank stock. They're just very average across the board. There's nothing ugly about them or nothing awesome about them. They're just good. They're just decent. And the next bank is going to be Capital One Finance. Their bread and butter are their credit cards, but they also do consumer loans and they have an online bank. And they recently just swallowed up Discover Bank. Their merger was approved. So ticker symbol COF, currently trading for about $182 a share. Their dividend yield is a little low. However, they make up for it for their really, really good dividend growth rate of 8.4%. I think that's really beautiful. And I think their performance in the stock market is okay. It's not ugly. It's not like awesome or breathtaking. I think it's just okay. And when we take a look at their tangible book value per share trend, about 5 years ago, it was a little inconsistent. But since then, similar to a lot of these banks that we already talked about, it's slowly growing and recovering and it's going in the right trend. And when we take a look at their profitability, I think this is a very average to slightly above average bank. They're not bad at all. I think when it comes to Capital One, something that you do want to keep in mind is that they do have slightly higher risk with so much credit exposure being a part of their bread and butter, but they have demonstrated a good growth in the stock market. It's just a pity that their dividend yield is so small, because otherwise I think Capital One would have been A- or B+ type of bank. However, because all of their numbers are pretty decent and average across the board and nothing is ugly and they don't really have a blemish, I think as of right now, they might be closer to a B- or even a C+. I think Capital One, let's just go ahead and say a B. Now the next bank is American Express, ticker symbol AXP, currently trading for about $264 a share. They're kind of similar to Capital One Finance because they're known for their credit cards. However, what they have that Capital One doesn't is they do payment processing, kind of like Visa and MasterCard. And if you know anything about that business model, it is absolutely an economic toll booth, economic mode, competitive advantage type of business. I love it. Because American Express does operate in the credit card space, like that being their bread and butter, the sentiment surrounding this company is that there's a little more risk associated with them during economic downturns. So more risk than what a traditional bank would otherwise face. Now, when we take a look at their numbers, their dividend yield situation is kind of similar, right? It's a small yield, 1.2%. But what's really impressive is that they're growing their dividend payout at a rate of 11.7% year over year, which is slightly higher than what SCHD does for the past 20 years on average. And when we take a look at their compound annual growth rate, I think this is a monster. I think this is beautiful. 10.8%. Dude, I think so far, this might be the best performer on this list. Yes, it is the best performer. And when we take a look at American Express's ratio being just shy of 6, it tells us either this company is really overvalued or it's super high quality and the investors have high expectations. There's a high trading multiple for a reason when it comes to them. Because, look below. When we look at their profitability, dude, this is elite level. A 34% return on equity to match that with a 3.7% return on assets. Dude, it doesn't get any better than this. So instead of the dividend yield catching my eye as a dividend investor, for me, this is what catches my eye. I'm like, dude, this company has crazy margins and ridiculous profits. I think this is high quality. So I think when it comes to American Express, it's definitely one of the best performing financial stocks across the board. Doesn't matter what industry or sector, they're really good. But I think it warrants that because they have premium quality written all over them. It's all over their forehead, all over their cheeks, all over their face. So there's a lot to like about this bank. So consequently, I think they're going to be right here as a C. No, I'm just playing. I think it's going to be our first S of the day for a good reason. I think this is what it takes to be in the S tier, to be this beautiful of a bank. I mean, obviously, I would want to see the dividend yield a little higher, but the yield on cost, if you buy into it today, sure, the dividend yield is like 1%, give or take a little bit. In the next 10 to 20 years, your yield on cost, it's going to be like a 3 or 4 or 5% dividend yield, especially if they keep growing the dividend at the rate they do, which is 11.7%. A lot to like about American Express. Congratulations to them, the first S of the day. The next bank is going to be Old National Bank. Ticker symbol ONB. They're a regional bank in the Midwest, but they also service Kentucky and Tennessee. And as we take a look at their numbers, my bad, let me post it right here. Currently trading for about $20 a share. Their dividend yield is 2.6%. It's okay, nothing crazy. However, not a fan of their dividend growth rate, being 1%. But we'll give it to them. At least it is growing, even if it's at a very sluggish and slow pace. And when we take a look at their CAGR, a 4%, I think it's just okay. It's not the worst thing in the world, but not pretty either. But when we take a look at their profitability, I think this is where they gain some points back. I think this is pretty solid. It's beautiful. So when it comes to Old National Bank, I think even though I was a big fan of their profitability metrics, because of their really small dividend growth rate and their below average CAGR, you know, how much your money would grow in the stock market hypothetically, I think this is just an okay small bank. I think there's far better options out here. So I think they're going to be a D+. I think they just missed the mark of being in the C territory. C minus, D+. They would be like right here, but obviously that's an eyesore. It looks really bad. So if I had to go with one, I think they would be right here in the D tier. So that's Old National Bank. And the next handful of banks are going to be the big names. We have Ally, Synchrony, JP Morgan Chase, Wells Fargo, and Bank of America. I'm saving the more popular ones for last. But let's not get ahead of ourselves, because right now the focus should be on Ally Financial. Currently trading for about $32 a share. They're one of the biggest players in the car financing industry because it used to be a part of GM's finance business segment. It was a spinoff. But they're also known for their online banking and loans. When we take a look at their numbers, I think their dividend yield is respectable at 3.6%. But what is really respectable with a capital R is the growth rate of their dividend, 11.3%. It's almost as juicy and as sweet as American Express. This is pretty darn impressive. And their compound annual growth rate for the past 10 years is 7.2%. Their IPO was a little before that of Citizens Financial Group. So 2014. We don't have 20 years of history to work with, but what we do got, not bad at all. Unfortunately, when we take a look at their profitability, this is not good, guys. A 2.1% return on equity, that's almost in the disgusting and ugly territory. But what is in the disgusting and ugly territory is a 0.16% for the return on assets. That is not good. But surprisingly, their CAGR is pretty darn good. So, Ally Financial Bank, it's a somewhat riskier business model, especially in comparison to the other banks because they prioritize auto financing and loans for new vehicles, but they do have decent stock market performance to back it up. So I think because of their really stellar and above average, actually excellent territory dividend growth rate and their stock market performance, I think they are going to be either an A- or a B+. I think as of right now, if I had to, I would rather go with an A-. But a part of me wants to bump them down into the very overcrowded B tier because their profitability is really ugly. However, their performance in the stock market and their dividend profile is what saves the day. Solid A-. And the next bank is going to be Synchrony Finance. They IPO'd in 2014. They're currently trading for about $51. And almost every major big box retailer, they work with Synchrony for exclusive credit cards like Lowe's, Sam's Club, and JCPenney. If you are a member of one of those places, look on the back of the card. It's going to say Synchrony, most likely. However, they also have an online bank that is pretty popular in the crowds of Reddit and other investing communities. Ticker symbol SYF. Their dividend yield is 2.3%. It's okay. It's pretty decent. Nothing to write home about. Dividend growth rate is just shy of the inflation rate, so a little below average. However, their CAGR, their performance in the stock market, is 7.4%. I would argue pretty good. I like what I see. However, something that I do want to call out about Synchrony is when I took a look at their tangible book value per share trend, it was very beautiful. almost delicious. It was consistent and growing year over year, unlike some of the other banks where they had an inconsistent year here or there, and it was growing at a very solid rate. And for further fuel for the flame, their profitability is just off the charts. An 18.6% return on equity, dude, that's bonkers. And return on assets being a 2.4%, very good. I think the one word to describe this bank is beautiful. And mind you, I don't own shares of any of these bank stocks. So before you think I'm coming from a biased perspective, this is not financial advice, but I don't own any of these bank stocks, yet. I might want to, but as of right now, I don't. So when it comes to Synchrony Bank, they do have a riskier lending portfolio and business model because it's consumer credit cards. However, they say high risk, high reward. However, when I think about their numbers and what we saw here today, I think this is a solid A tier type of bank. Everything was just phenomenal. Dare I say, they were almost into the S tier, but they just missed the mark. Amongst the competition in the A tier, let me just do this for fun, okay? I think Synchrony is better than Ally, but slightly below PNC. So I think their true grade would be an A plus or even an S minus. However, I don't think Synchrony belongs in the same boat as American Express, and it's not because I'm racist, it's just American Express's numbers were just that much better. But being in the A tier still means it's a pretty solid bank. And I'm gonna tell you this right now, before I started doing this research, I didn't think that Synchrony was gonna be in the A tier, let alone B. I thought based off of what I know of them, they were gonna be somewhere in the D or in the E tier. However, their numbers and their data speak for themselves, and their financials and balance sheet look pretty darn good. Now it's time for the big boys. First one is going to be JP Morgan Chase. Ticker symbol JPM, currently trading for about $243 a share, and it's a universal bank. They do asset management, retail banking, and investment banking, and they even do credit cards. And out of this entire list, they are the biggest bank by market cap. And as we take a look at their numbers, a 2.2% dividend yield, decent. Their dividend growth rate, a 7.6%. Phenomenal. I think that's pretty good. However, this is where things get a little silly and a little wild, and it might be a scandal, because this is not a typo. When we take a look at their CAGR, their compound annual growth rate, dude, a 13% year over year. I think that's really strong. That's really beautiful. And just by these numbers here, 7% dividend growth rate and a 13% CAGR, dividend compounder with cheese. But let's keep going. When I looked at their tangible book value per share trend across the years, by far the best on this list, no doubt in my mind. Ridiculous growth year over year. It's like aggressively growing, which tells me it's a very solid company with strong financials and an excellent balance sheet. Case in point, when we take a look at their profitability, a 17% return on equity, dude, that's crazy. A 1.4% return on assets is also good. So I think when it comes to JP Morgan Chase, they're simply the gold standard of what it means to be a really good bank company. And they probably have the strongest balance sheet out of everybody in this crowd. I just wish their dividend yield was at least 3%, but you can't have it all, right? You can't be super perfect. I think they make up for it with everything else. So I think, does it come as a surprise that they belong in the S tier? It is just a phenomenal stock, business, and investment. That's not financial advice, but from what I just saw on paper, I think it's a pretty solid bank. And funny enough, they've been on my watch list for like the past 7 or 8 years. So something caught my eye about 8 years ago, and I think today reinforced the idea of why they've been on my watch list. It's a really good company. The next one is going to be Wells Fargo, ticker symbol WFC. Very similar story to JP Morgan Chase, but unfortunately with more scandals in their business history. As we take a look at their numbers, a 2.3% dividend yield is about the same as JP Morgan Chase. However, the difference between these two companies is the growth rate. Their dividend payout has been shrinking for the past 5 years at a rate of 4.7%. Yes, shrinking, negative. That means you get less dividends year over year on average. Not good. However, what is surprising is that performance in the stock market for the past 20 years is 7.3%. I thought, based on their scandals and their reputation, it would be similar to Citibank, where it's going to be negative or in the red, but surprisingly, that is not the case. However, what is kind of crazy is when I assessed their profitability, pretty good. So, on paper, it's a pretty darn good bank. Because of their scandals and Wells Fargo just shooting themselves in the foot, I think it hurt their performance in the stock market. So on paper, it's a good bank. But in reality and in the stock market, not exactly the best investment. So I think when it comes to Wells Fargo, it's absolutely a recovery play. However, their reputation is not pretty. There's a lot of consumers, such as me, who would never ever work with Wells Fargo. So it would have to be more so their commercial banking and their investment banking arm to make up for the consumers not liking them. And something else about Wells Fargo that just rubbed my left nipple the wrong way is their dividend situation is just not good. So when I think about all the factors and numbers going for them, I think I would put them as a C-, almost D+. I think bumping them down to the D tier would be a little too harsh because their stock market performance has been pretty darn good despite the scandals and setbacks. I think if it weren't for them, they would probably have a CAGR that rivals that of JP Morgan Chase. I know that's a bold statement to make, but as of right now, I think Wells Fargo is a C-. It's a very average, slightly below average type of business. And you made it to the end. The last bank is going to be Bank of America, ticker symbol BAC. This is Warren Buffett's favorite. And also his pupil, Lee Lu, he likes it as well. For both of those super investors, it makes up a good chunk of their portfolio. And when we take a look at their numbers, I think it makes sense. Dividend yield being a 2.6%, it's decent. It's not outrageous, but it's also not disgusting. The growth rate of their dividend, pretty darn good. However, their performance in the stock market, I think, nothing to write home about. At 1.6% for the past 20 years, year over year, for your money to grow only at 1.6%, that's almost offensive. That's almost discriminatory. That almost invokes anger in me. That's just not good enough. However, something that I do want to call out is their tangible book value per share trend is pretty darn good and consistent. Year over year, it grows. There's no dips, there's no declines. Not at the pace of JP Morgan Chase or American Express, but it's reliable and it grows year over year. And when we take a look at their profitability, I think it's right at the standard definition of what makes it decent. I think they slightly missed the mark for the return on assets, so slightly below average, but overall, I think it's pretty darn decent. It's not outrageous, but it's just average. So I think all things considered, when it comes to Bank of America, I think it's a high quality bank. Dare I say, right? It's close to JP Morgan Chase, obviously not to their level and caliber, but it's not a bad bank at all. It's pretty good. It's just a shame that their business fundamentals don't match their stock market performance because I think otherwise they're pretty good. And I really like how Bank of America has been growing their dividend payout by 8% year over year. It's just the return on investment, their performance in the stock market is just, it's not good. So with all of that said, I think they are what makes a C- or D+ type of stock, investment, business, bank. I think, is it fair to put them into the D tier? Because their performance is what is weighing them down. It drowns them. Do you remember earlier I said that? Would you want to invest into a quote unquote good bank if you knew you would be losing money by investing into them? Probably not, right? And I think that's the perfect poster child of who I was referring to, Bank of America. Good fundamentals, good financials, good balance sheet, but just poor, piss poor actually, performance in the stock market. So let's talk about some takeaways from this experiment and research. I think when we talk about the best dividend growth rate, by far, American Express at 11.6% is the king of this list, and closely followed by Ally Bank at 11.3%. So those two banks are the ones that I would label as the best dividend growers. However, a distant third place would be Capital One Finance because they're growing their dividend at 8.4%. And I think Bank of America just missed the mark of being that bronze medal of an 8.1%. So if you're going for a dividend growth rate, it's got to be American Express or Ally Bank. And when we think about the best performance, the one that would grow your money the most, the total return, number one is going to be JP Morgan Chase. That 13% growth rate year over year is just beautiful. Okay, second place would be American Express at 10.8%. And then third place, I think objectively is going to be PNC at 8.7%. I think you can't go wrong with any one of those three if you're looking for performance. But thinking outside the numbers, how would I give the gold medal across 3 different categories? Number 1 being the best for that dividend income. Number 2 for the growth going forward. Who's going to be the biggest grower in the future? And then number 3, who is the best bank overall? If I had to bump someone up to the S+++ tier. Well, first and foremost, the best bank for that dividend income is going to have to be PNC. At least it is for me. Their dividend yield being above 4% and their financials and everything else looking good as well, I think not a bad thought. That's not financial advice. And on the other side of the spectrum, the one that I think is going to be the best CAGR in performance and total return in the future, it's going to be American Express. I think there's a lot to like about American Express. Although I will say this, a really solid alternative, I think I alluded to it earlier, it's going to be SCHD. Because not only does it match the dividend yield of PNC, the CAGR and everything in between, I think SCHD is going to meet or exceed the growth story of American Express. And I say that as a cult member of SCHD. And the gold medal for the best overall bank, the dividend yield income plus the CAGR growth story, both worlds being married, being bald and handsome at the same time, for me, it's gonna have to be JP Morgan Chase. I think their numbers, their balance sheet, their performance, their profitability, a lot to like here. And if you're curious to know what my personal game plan is going to be, especially after finding out the results of evaluating, grading, and ranking all of these different bank stocks, well, I'm going to post that exclusive information to Patreon itself, including the price that I am willing to pay for that XYZ bank stock. Now, here's the crazy thing. I was contemplating putting this entire video behind a paywall such as Patreon. However, I decided ultimately to give it away for free. So, with that said, if you appreciate the content and you think I'm decent, then please join the Patreon because there's exclusive stuff that I post on there that never makes it to YouTube. And with that said, Amos wants to say thank you for supporting me. This video was made possible from the support on Patreon by viewers like you. And before I sign out, I wanted to give a big shout out to Wrexham. Oh my goodness gracious. Mathematically, they just earned enough points to be promoted to the EFL Championship, which is absolutely bonkers. Now here's my story as to why I support Wrexham. About 3 years ago, I got into soccer and I started watching documentaries about soccer, right? Like I watched the All or Nothing series, Tottenham, which is why I ultimately became a fan of Tottenham. I watched Sunderland Till I Die, and I watched Welcome to Wrexham. And so ultimately I decided to become a fan of Wrexham and Tottenham. Now obviously with Tottenham, it was a very emotional season. We lost more games than we won, but however, we are in the semifinals for the Europa. And on the other side of the spectrum with Wrexham, dude, I love rooting for this team because after I watched all the episodes of Welcome to Wrexham, which is a docu-series about the football team, of how the 2 Hollywood actors went over to Wales to become the primary owners of that franchise, it kind of made me feel like I'm a part of the community, even though I've never been to the UK. Now, domestically, in the MLS, I support the Seattle Sounders. However, that's another story. But I'm sure nobody even cares, so I'll stop myself. Anyways, I love you guys. Stay safe. Good luck in the stock market, and I'll talk to you guys really soon. Peace.